Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to a Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Today, I'm joined by Jordan Sute Norton from Sute CPA. Hey, Jordan.
Hey, how are you?
Good. Jordan's a regular from Sute CPA, which can be found at sutecpa.com.
Correct. That's right.
I'll get that plug in there early.
Yeah.
Usually I wait till the end.
That's good.
So this is an important podcast because so many people, well, not our clients, because we're on top of this,
right.
But so many people worry about their taxes when it's too late. They wait till late February and they go, oh my gosh, I need to make all these changes to my taxes. I'm like, well, the year's ended.
It's a little too late. Right.
Well, it's very too late.
Right. You're right. We actually just finished our filing season Monday for the extensions. And I even had people in October saying like, you send them their return and they're like, What can I do? And I'm like, oh, we
way
need to
past
be planning right now for 24, 23, like we're way past that point. So yeah, everything that you need to be doing, most of it has to be done before year end. So now's a great time to start thinking about those things and putting them in place.
So we have a lot to cover. So let's just kind of dive right in and talk about point number one, sizable available deductions. So we have an increase in the standard deduction this year.
Right. That's great. But I think there's some low hanging fruit here that I think everybody needs to go after. That's maxing out employer deferred accounts. And then, yes, you have the increased standard, but also considering charity. I think that's the biggest piece that we can talk about with individuals, especially the ones, most of our clients. How can we make charity work for us? Because so many of them are charitably inclined, but maybe they're not strategizing their giving in a way that could help them for tax purposes while also still benefiting the charity of their choice. So there's several different ways that we can kind of help them think through that so that they're maximizing the tax savings.
Like what?
One is charity bunching. I think that's a really big thing that people can put into place. So let's say the standard deduction, I don't know what the 23 is exactly.
27.7.
So that's huge. That's high.
Mm-hmm.
So let's say you're probably already capping out your state taxes at 10 grand through property tax, income tax to Georgia. And then we probably have some mortgage interest, but then maybe we're coming right in beneath that 27,000 with charity every given year. But maybe if we took 2 years of charity and we put it in 1 year, then we could overcome that hump. So now we're we're itemizing every other year as opposed to just staying underneath the standard every year. Mm-hmm. So so maybe you write a big check in December for your church or your charity of choice every December, but hey, maybe we push that December check to January and then we make our next year's check in December so that we've got 2 years of charity in one calendar year, but really your charity felt the benefit kind of the same way they normally would, but you are now benefiting from a tax purpose or tax standpoint because you're itemizing way more than you normally would, or even you might not in a typical year. So that's a great strategy for just doing things a little bit different, just changing up the timing, but still everyone's feeling the same, getting the same at the end of the day.
Yeah, you can do the same thing with a donor advised fund if you don't have a charity in mind, but maybe you would in the future. You could always open up a donor advised fund to do that. Absolutely.
Especially in those high income years. Maybe you're not ready or you don't know who you want to give to yet, but you want to take advantage of being in those high rate years.
Yeah.
Taking even cash is great. Appreciated stock, even better. You're donating to this donor advised fund that you guys could hold and help manage. And once you give the stock or the cash, it's a donation as of that date, the value on that date. So it's a great way to get, these winners, I guess, out of your portfolio, not pay capital gains tax, and then it can be invested and it can grow in that donor advised fund. And you can decide between now and the end of your life who gets that. And then you can even set up a successor. So it's a great tool to maximize tax deductions, especially in those high income years.
So let's talk about making the most of higher saving incentives. So we have IRAs, so you can contribute up to $6,500 this year. which is $500 more than 2022. If you're over 50, you can add additional $1,000 to that, to an IRA.
Right.
Now you can do a Roth. The Roth IRA limitations are the same. So if you have a 401k, you can't contribute to an IRA, but you can contribute to a Roth if your income's below a certain limit.
Right. And this is one of the few items that I would say maybe wait until tax time.
Yep.
To make your contribution, because you don't want. I talked to so many people who are like, "Hey, I made a Roth contribution." I'm like, "Oh crap, you're over the limit."
Right.
And so then it's just to be compliant. There's a lot of paperwork and forms that have to come as a result, and it can just be burdensome. So that is one thing. You wait until tax time, right before you file your return. You ask your CPA, "Hey, am I eligible?" And they'll tell you yes or no, and then you can kind of work off that advice and not having to undo anything that you've done previously.
So I know we're going to get phone calls on this, Jordan. So I'm going to cut this off right now.
Right.
We have clients who put money in every single month into their Roth. So you don't have to call me because we already did the tax planning.
Right. Yes. If you know,
if we know you're going below the limit, then we just put it in monthly.
Exactly. Yes. If you know and you've planned for it, then that's great. Go ahead and get it in there, because I know you might be missing out on some appreciation. But for especially young people whose income is maybe
rising.
They've always been contributing to a Roth because their parents told them to. And
or
that's
all
great.
the Delta pilots in 2023 who got the big bonus.
Right.
You're probably not eligible for a Roth anymore.
Yeah. As that income rises, just kind of slow the brakes, on just the automatic putting into a traditional, and you can always put into a traditional, even if you're technically not allowed. I don't know how you feel about the basis, adding up in a traditional IRA. But
I've seen the other side of that. So what she's talking about is if you put money into a traditional IRA, but you're not eligible for the deduction, you would withdraw it. You put it in after tax, and then when you withdraw it, part of it is after tax money, and part of it is kind of like pulling out of your brokerage account, I guess, and then part of the gains would be taxed. So it's going to be very confusing to execute, and the brokerage houses have no way of calculating that basis. So only your CPA can do it.
Right. And it's not like a first in, first out.
Right.
It's just if you put in $50K of after-tax dollars into a traditional, but your IRA is $1 million.
Right.
It's just pro rata. So then it's not the first $50,000 you take out, tax free. So it's not a win-win unless you're doing the backdoor Roth. I think.
I was going to say what I would do is just go ahead and convert it. If you're going to do that, just convert it to the Roth, and now it's all really clear accounting wise, right?
Absolutely.
HSAs. So this one's kind of sleepy. I think a lot of people don't realize the benefits you can have with an HSA. Right now, you can put away $3,850 for an individual, or $7,750 for a family. And a lot of companies now are offering HSAs because it saves them on premium, and then they give you an incentive to do it by adding some cash to it.
Right.
Your deductible is higher. If you're a heavy user of healthcare, may not be the best way to go.
Right.
I'm not going to pretend to be the healthcare specialist. We have Logan Steele who comes on and talks about that stuff. But the cool part is it can grow, and it's basically like a Roth for healthcare. Mm-hmm. So you put money in, you can invest it eventually. I think there's usually like a $3,000 minimum or something you have to keep in cash. And then the benefit is if you have 20 years to go, you can growing that. And once you're retired, you can use the HSA to pay your healthcare premiums. So in a financial plan, it works out really, really well.
Yeah.
And so what that means is you don't spend it. If you have to go to the doctor, you pull that out of your checking account. You don't pull it out of the HSA.
Right.
But that's a great way to. If you're in the 37% tax bracket, $7,750, basically do that times 37%. That's the dollars you're saving on your tax return.
Exactly. It's a no-brainer. Yeah, for sure.
Another one is $529. So in Georgia, you can put away $8,000 a year. Mm-hmm. And you're saving a few $100s on your tax return. That's per child though, right?
Per child, and it's state benefit only on contribution. So it'll grow tax-free when you take it out for your child's college or even like private education in high school. The earnings aren't taxable,
right?
But you do get a benefit on Georgia on your Georgia tax return if you contribute to a Georgia plan. So you're right, $8,000 a child. So it comes out to about $400 off your Georgia tax return each year.
I believe that's Path to College 529. Mm-hmm. We can put that in our show notes too, the link to that. Just use the age-based account, and it kind of goes on cruise control at that point. You don't need a financial advisor to be selling you that for sure. TIAA is who manages that in Georgia. All right, let's talk about putting your savings to work. So tax efficient investing.
This is a good one. And we were kind of discussing this just earlier this morning. I feel like a lot of people fall into one of two boats. They either want to pay in to the IRS all the money they can ahead of time to get a healthy refund in tax time, or you have the kind of the other side of the card where they want to pay in the least amount possible and owe in April with no penalty. And I will admit, I've usually been in the, hey, I just will overpay and get a refund. It feels, kind of like a little bonus in April.
Right.
But as I've gotten older and these, the savings account rates have increased, now I'm like, why would I pay them any extra money if I can hold on to that penalty free,
right,
pay any balance I owe in April, and my money's in a high yield savings account growing at, almost 5%. So I think that's, with these rates, yes, the IRS's interest rates are high, but your savings account rates are high. So take advantage of that right now. If you have the cash, leave it in your savings account and pay your taxes in April to the extent you can. And you're raking in some money that you wouldn't have otherwise.
Right.
And I think that kind of leads itself to, people are probably like, well, I have no idea how much I'm going to owe in April. What do I do? And for us, like right now, this is a time of year between now and probably, I guess, middle of December. We are in full planning mode and projection mode. So meeting new clients, onboarding new clients. And part of that is, we typically work through a projection, meeting with our current clients. Hey, how are things looking? Doing a health check. And just seeing like, hey, what do we need to make for a fourth quarter payment to keep you compliant? And what can we hold on to until April to pay the IRS? And that way we're just maximizing your ability to keep your own money, do with it what you want, have, Casey help make you some money in the market. And so I think it's such a good time to sit back and do a health check with your financial advisor, with your CPA, just kind of all at the table.
Yeah. I wouldn't put that in the market, but definitely the high yield savings accounts are going to do well. And why would you give the government a free loan?
Exactly.
Let's talk about tax loss harvesting. So this is the time of year you start doing this, and this is for your brokerage accounts, not your IRA, your Roth. It wouldn't matter there. But essentially, what we do is we have one model portfolio, but we have two alternates. And so what that allows us to do is, if you have a loss in the S&P 500, you can sell it for a loss. You immediately, within a millisecond, turn right back around and buy an S&P 500 like fund, and you are able to write those losses off. So this year, there are some losses out there this year. Year to date, there are asset classes that are down, but the broad market's up. So it'd be a little harder to do that this year. You really want to be doing this in like 2022. For advisors, if you're not doing this, you're definitely not living up to your best potential for your clients. Right. It's such an easy process to go through and examine the portfolio and figure out where you need to make those changes. But look at it this way. If, we had a client last year that is going to be selling a commercial building for like a $1.5 million net profit. Last year it's a very large account, obviously, but last year we were able to realize $600,000 in losses. Those $600,000 in losses, you can only write off $3,000 a year. So like, oh my gosh, I have like a lifetime worth of losses,
right.
But not when you know that you have an event coming up.
Right.
And so now when that $1.5 million sales goes through, we have these write-offs. Now, did they actually lose $600,000 on paper? They did, but they were immediately reinvested into almost identical holdings, which we did this in 2022, which now has rebounded almost back to its full potential,
right,
or full value.
Yeah.
So that's the strategy.
Yeah.
It's harder sometimes for people to do this at home themselves because they're not monitoring the portfolios on a daily basis. But there are trigger points in a year, really bad weeks. Right. Where you go,
right.
Maybe we should take that loss and move on. So that's the idea behind tax loss harvesting. There is a wash sale rule. Mm-hmm. So you have to be careful that if you sell something for a loss, you can't just go back and rebuy it.
Right.
Like within a day, you have to wait 30 days.
Right.
Which is why we have alternate portfolios, because we don't want to wait 30 days.
Right.
Because we might miss something.
Right.
So
Yeah, the wash sale. I mean, it's. I always hate to see them because you have this loss, and then there's another column for disallowed loss. I'm like,
Right.
oh gosh, but yeah, I mean that's why you have competent advisors on your team to help you avoid that.
So it's wash sales sometimes are hard to avoid. We cause
Right.
wash sales, but they're very small.
Yeah.
So it's for example, when you reinvest your dividends every single month, like a bond fund, and then you sell that bond fund, you buy, you do a rebalance of some sort. Sometimes you can trigger a wash sale, but we're talking probably less than $5.
Right.
But yeah, the big stuff is the stuff you want to avoid for sure.
Right. And I know we saw, from a tax preparation standpoint, huge gains in 20 and 21 capital gains.
Yep.
And then this past year was not the case. We see lots of capital losses. And just like you said, I mean, you get to take $3,000 of capital loss. You offset any capital gain you have, those
Right.
net out for the year. And then whatever your net loss is, you get to take $3,000 and then the rest is carried forward. And so I think that's a good point to remember. Like we're going to see hopefully, capital gains this year, but we do have these losses in our pocket already without
Yep.
even doing, tax loss harvesting within the year to offset some of those gains. And I think that's a good point too, because I feel like when we get new clients so often, sometimes, the first thing we say is, hey, we need your last filed tax return. And I'm sure people wonder, why do they need that? But there is so much key information that you do not want to miss out on.
Capital loss carry forward.
Capital loss carry forwards. Yeah. Passive activity losses, these things that you have not been able to use in the past that you will be able to use at some point. So might as well. We don't want to lose those. Those are huge. You're just leaving money on the table. So it's a big thing to make sure that you're keeping track of that. If you have a good CPA, then they're going to do that for you. But even just preparing yourself, if you're switching from one software to another, I mean, I would be really cognizant of making sure all your carryovers are there so you're not missing out on anything.
Roth conversions. So this sounds so easy. We do a lot of analyzing on Roth conversions. The idea is to convert an IRA to Roth. And I swear, like one article in AARP and everyone calls and says, we need to be doing Roth conversions.
Right.
I was like, no, that's a very individual one-on-one decision. So here, the concept is this, is that you have an IRA, it's going to be taxable if you pull it out. So you pull it out now and convert to a Roth.
Right.
But when do you do this? And why do you do this? So the scenario in my head is you do it if in the future your required minimum distribution is going to be high to where it's better to pull it out now and pay a lower, not the same, but a lower tax rate. So if you pull it out now and you're going to be taxed at 24% and you're going to also be taxed at 24% in the future, why would you prepay your tax now?
Right.
Right?
Great point. Yeah, absolutely.
It's like, do you want to pay your tax now or do you want to pay your tax later?
Right.
Later, please.
Yep. Absolutely.
Right?
Absolutely. Defer.
Defer.
Yeah.
Exactly. Now, here's where I had a situation this last week where we have a new client came in from the great company Raymond James. Raymond James is an asset manager, not planners. And so they come in and he has no income. He has Social Security, all of which he doesn't pay tax on, very low income. He has this IRA and he has a Roth, right? I looked at him and said, have you been doing Roth conversions? He says, no. I said, you literally could convert over the next 3 years your IRA into a Roth and pay zero tax.
Wow.
He's like, what? Why didn't another guy tell me that?
Right.
And he's only here because I think the rest of his family came here and he was like, well, everybody left the guy, so I guess I should too. So it wasn't like he was upset with the guy or anything.
Right.
But the point is that asset managers are not planners.
Right.
And so in his situation, because he had zero income, he could convert over the next 3 years. He'll have converted everything to a Roth. Now he can pass on that asset to the next generation at 0% tax, where before, when his only daughter inherits the money, she would had to have paid tax at her income tax bracket, which was very high.
Right.
It just drives me crazy, right?
Right.
So in that case, yeah, you do that. The other case I think is 12% is really hard to get to say, unless you're going to be at 12% the rest of your life. it's hard to say no to a 12% conversion.
Right.
Meaning that you pay tax up to 12%. So for a married couple, that's usually up to what is it, about 68,000, I believe.
Yeah.
It's in that ballpark.
Right.
So you can convert to 68,000 at 12%. But again, you have to do the math. And to help Jordan and her team out, we have some retirement calculator or tax planning calculators here. We don't do tax returns. That's why we have you, Jordan. Mm-hmm. But we run this through our Roth conversion calculators,
right,
and try to forecast out the future,
right,
and basically determine, okay, should we be converting or not converting? And there's people who have been converting or think they should convert. And a lot of times I'm saying it's just not worth it. You're going to be in the 12% tax bracket your entire retirement. Now, the only thing that people will come back with is, but taxes will be higher in the future. But will they?
But who knows? Who knows? Yeah. That's not a bet I'm willing to make. So it's, Who
it's
knows?
Like, oh no, taxes have to be higher because, and they read all the political propaganda. Taxes are going to be higher because of all the COVID stimulus and because of all these other things. And I don't know. I don't,
a lot of what ifs.
I don't quite buy into that.
Yeah.
I think that you look at what artificial intelligence is doing right now and the efficiencies that it's bringing. Mm-hmm. I mean, just in us writing a white paper takes half the time that it used to. We might be able to do podcast show notes using AI, which eliminates somebody having to re-listen to the podcast and take notes and put them into the system. So there's going to be more efficiencies in the future. So if you have more efficient workers, who are making more money or doing more jobs, right?
Right.
You may not have to have higher taxes.
Yeah, I agree.
I mean, I'll just work out because we're supposed to be having higher taxes right now for sure. And we don't.
Right. You're right.
So I just wouldn't bet paying a higher tax bill now that the future is going to be like way different.
Right. I completely agree. And I think too, with the Roth conversions, I think this is why it's so important to have somebody like you involved in the picture. I was talking to a client recently about, she's really antsy to convert to Roth. And so she was like, just give me some scenarios. If I convert this much, where does that, put my rate? And so we just kind of were looking at it. And then her financial advisor, we loop him into the picture and he's like, but wait a second, your Medicare premiums will go up if we cross. Yeah. And I'm like, see, I'm so glad that you're involved here because I have no insight into this information. And so I think that's why it's important to have everyone at the table with these conversations, because otherwise he might, encourage her to do something that I would say, hey, that rate's too high. Whereas I might encourage her to do something where he's like, wait a second, her Medicare premium. So having everyone involved and talking together, not just one person making that choice or recommending a decision, I think is super important. Yeah,
that's the role of financial advisors, to kind of put everybody, because, CPAs, if they do their job well, they're trying to get you to pay the least amount of tax. And then attorneys are trying to hide everything. And so in the end, the financial advisor's job is to coordinate between the two and say, this is the objective.
Right.
Yeah. But yeah, that is a big gotcha. Our chart has a little line. It says, hey, if you go above this number, premiums are going to increase. Yeah. I think Roth conversions while you're working, I don't know there's a world that it makes a whole lot of sense.
Yeah.
All right. Well, we already kind of covered this one. Do a checkup. So doing a financial checkup can help make sure that you're paying the right amount in. Yeah. So those W-4s, you have a big pay raise or a job change, getting those W-4s right, make sure there's not a surprise.
Right. I tell people too, like, I would much rather have the surprise conversations now as opposed to at the end of March or the end of, middle of April when they're getting their tax return. Let's talk about it now, just so that you're prepared, and then let's fix it moving forward, especially because I feel like the W-4, it's like 4 lines, yet it causes so much confusion. And it's just not a great system for what we have in place. I mean, there's so many other factors out there, impacting your tax return. A spouse, children, itemized deductions. And so it's really hard to get it right. So just doing a health check and knowing, you think, just from growing up, they're always withholding enough. Yeah. But as your rate gets higher, you start, receiving bonuses or RSUs. They're never going to withhold it at enough. So it's just something to always kind of be thinking about and getting in front of.
I mean, you keep talking about meeting and planning and looking at your current tax situation. Are you guys doing that for most of your clients? Is it like at request?
It's at request, but it's something that we consider to be a part of our services. So I tell people, hey, it takes a hand raise. Like, hey, like, can I get on your calendar? And then it's an immediate yes. Like, yes, let's do it.
Yeah.
I mean, some people have no interest. Every year it kind of looks the same, and so I mean, by no means we're not going to force you, but it is kind of by request.
That's the biggest complaint. I have no complaints with Sute, but biggest complaint we hear from other people who are looking to make a change is that, well, they just file a return. And I did have to return. I had to fill out this long questionnaire. The organizer, right? And I fill it up some way every year. No one says anything. I just get this thing back. And,
I try to reiterate that. Yeah. When we have these onboarding meetings, I take these new client calls and I tell them, like, we want to plan with you, because that's how I get to know you. That's how I know what your goals are and what you want to achieve. And then we can help you find things to, put that plan in place or recommend items for you. And it just creates a great working relationship, and it builds trust and just I become a resource, or our team becomes a resource. And I think it's just a win-win for everybody.
Let's switch to estate planning. So you can gift $17,000 per year. And we have this big wall coming up at the end of 2025 where a lot of things are going to sunset. A lot of unknowns at this point. 2025, that'll be interesting. I mean, a lot of it will have to do with what happens in 24 in politics. Right. I don't think that we've talked to Sean Shelton about this on our podcast, but I don't see the estate or the estate tax, coming down to $500,000. It's probably going to be much higher than that. Yes, I completely agree. Cause it all gets indexed for inflation anyway. Yeah. But, I can't say much more to it other than if you have a large estate, you probably should start your gifting strategy to start moving money out of the estate. Absolutely. And that's $17,000 gift per person. So it's husband can gift 17, wife can gift 17. Yeah. 34 to any individual, or non-individual as well. I mean, we can get really technical there. Talking about really big gifts. But you could start funding, grandkids 529 plans, start maybe gifting near Christmas time, or I always say surprise people. I've been doing this for 23 years, and the families that give X amount of dollars, I work with the kids and the parents. And the parents are like, yeah, I think we're going to do this year again, the gift. And then you work with the kids, are like, oh, my parents gift me $10,000 every year. Right? So maybe there needs to be an element of surprise. Right. Yeah. So switch things up. You do it 2 times, and it's like, oh, we do this every year. Yeah. And it's nice too, because there's I guess if the IRS ever came calling, you would have the receipts, but there's no reporting or filing requirements for those gifts under that threshold. It's past that where we would have to start discussing, okay, what's the risk here? We need to start filing gift tax returns. And I think there's a lot of confusion over gifts because, I get, people call me and say, my grandfather, wrote me a check for $50,000. Like, what do I need to do? How much tax do I owe? And I'm like, you have no obligation. It's him that should make sure that he has his ducks in a row, for filing. And again, there's no gift or there's no tax on the gift. I mean, under most circumstances, we're dealing with really high numbers for thresholds with the gift tax. Yeah, let's talk about that for a second. So if you die, let's say husband and wife die in a car accident, the estate has to be worth over, I think it's 24 million now, right? Before any tax is owed. Yes. So what this means is that check for $50,000, well, 17 of it is a gift anyway, no tax owed by anybody. Right. But the difference would be subject to tax unless you do what? Unless you file a gift tax return and it gets reduced, your exclusion, that 20 plus million gets reduced by the excess. So, so he could say, well, I didn't give 17, I gave the full 50. He reduces his $24 million exclusion by $50,000 and there's no tax owed by anybody. Exactly. Yeah. That's a very misunderstood. Yes, absolutely. Process. It really is. You have some bonus comments. I do. Some business planning. Yes.
as well.
I like business planning.
I do too. Yeah. Just some things to keep in mind. I know that we have a lot of self-employed individuals, mutual clients that, have their own businesses. It's just some things to think about. I would say probably 99% of our clients are cash basis business clients. So that means that you pay tax on the income you've received in a calendar year, and you get to deduct any checks or expenses that you've had in the calendar year, as opposed to accrual, which is, a little bit different and some timing factors at play there. So what we say to business clients is, if there's anything that you think you need in the next, in the first 3, 4, 5 months of 2024, go ahead and order that in December, put it in place in December so that we can write that off this year. And it's just a timing game that you're playing, but so long as your business is in effect and growing, it's always going to be a thing that you can implement. So it won't ever be a problem until the end, and then we might have a little extra income, but that's, a problem for then. This is the name of the game is deferral. So to the extent that you can wait and cash checks in January, or wait and receive income in January, that's a good play as well. But just accelerating any deductions that you have into the current tax year is an awesome tool.
We did that with payroll this last year at our firm. And it saved me a lot of money in taxes.
Nice.
Yeah. It was a difference between owing a significant amount, owing an amount that I could just curse at as I wrote the check, but not feel sick. Right.
Rather give it to your employees than
exactly.
IRS.
Because usually you pay on the 1st, but we just wrote the check on the 31st.
Nice.
That was the only difference.
Yeah.
So that made a huge, but now this next year I have to do the same thing, or else I'll have that bigger, that much more of a gain.
Yeah. 2 less payrolls throughout the year to write off.
Exactly. But you can front load that. I will say this, I am working with a couple of situations now where one is a business being sold. The other one is a business bringing on a partner, which the valuation of the business is very important. So there's doing what you need to do to have a lower tax return, and there's doing what you need to do to get the right valuation.
Right.
And the valuation doesn't come from, well, it was this, but then I added this as an expense only to lower my taxes, and so we have to add that back in. That doesn't work like that.
Right.
So you have to be very careful that your banker doesn't understand taxes.
Right.
Bankers serve a purpose. I think I understand what their purpose is, but they don't understand taxes. And so when you do that and they go, oh, you had a reduction in income this fourth quarter. I don't know about this. I'm kind of uneasy about your business now. And they have no idea.
Right. And I feel like this gets back to the 2020 election, or whenever it was, and everybody's like, I want to see Trump's tax returns because he pays no tax. Right. And I'm like, he's the smartest taxpayer in the world because he pays no tax. Like it's just a cycle of front loading deductions at the end of the day. I mean, mixed with obviously a lot more, but at the end of the day, he's just using hopefully the tax code to his legal advantage.
The problem with that whole situation is that nobody really understands corporate taxes at all.
Yes.
Much less their own personal taxes, and everyone's trying to weigh in.
Right.
And that was when they finally got released. That was so comical. That it was just on Twitter, just all the comments, and I'm like, oh my gosh, these people have no idea what they're talking about.
Right.
It's no different than these are not just these are media people, not even just stay-at-home people.
Right.
Whose comments were hilarious, but it just goes back to what. The media in general, if you really know something about something, you realize how much the media doesn't know anything about anything.
And you also realize how much people who also know things use I don't want to say ignorance, but it just kind of people not understanding things to their advantage. Of course they're going to say he's a terrible businessman.
Oh yeah.
Yeah. His businesses don't make any money. And full and well what he's doing.
Exactly. Well, it's no different. It's no different than the airplane crash, and you have all these experts, and I know a few things about airplanes, right? And you're just no, that's not how that works. Yeah, no, that's not. You're watching CNN, and they're like, you're the aviation expert. And I'm like, the dude hasn't touched an airplane in 30 years. He has no idea what he's talking about.
Yeah, exactly.
So let's. You had a note about C corporations. And S corporations.
Yeah. So most clients, I would say, with, self-employment earnings, small businesses, they start on Schedule C. If you're a solo, you're in business by yourself for yourself. And then at some point you might want to consider, hey, is there tax advantages to moving this off of my 1040, maybe to an S Corp? And there are huge tax advantages to doing that, but it doesn't come with its own responsibilities. And so one of them, just kind of out of the gate, is filing an S Corp election and having it be a timely election. And so now is a great time to sit down with your CPA again and say, hey, here's my earnings to date. And so we kind of look for about a $75K net number on Schedule C. Yeah. And that's where we say, hey, I think we might need to think about S Corp status here, because now the benefits of S Corp are going to outweigh the cost of the additional filing. There's some payroll costs that come into play. And so that election for the year in which you want to be an S Corp needs to be in effect by March 15th. So you have 75 days from either starting your LLC, and that's like registering it with the state, or the year in which you want to be an S Corp. So that's a form that needs to be filled out. I mean, ideally now, so that you're well ahead of the deadline. But after that deadline, it's not unheard of to file a retroactive election. It's just not easy. So just something to start thinking about. So
the strategy here with S Corporation is you would pay yourself what IRS deems a reasonable salary. Mm-hmm. So let's say you're making $150,000 a year and you're going to take a $25,000 a year salary, of which you drop into your simple IRA or your SEP IRA. And then the rest you take draws on. And those draws you pay income tax, but you're not having to pay the 3.5% in other tax. What is that?
Well, payroll tax.
Be the payroll tax.
Yeah. So on Schedule C, if you're making $150, you pay income tax, and then you're paying, 15% at that point, and you're getting in payroll tax, you get a deduction for half of it, but it doesn't come out to an even, like, I'm just paying 7.5% in payroll tax, but it's burdensome. Somebody's like, oh, I'm in the 24% bracket. Well, no, really call that like 32 at the end of the day. So by moving that income
because of the self-employment tax.
Yes, because the self-employment tax on top of the income tax. So by moving that off of Schedule C into an S Corp, it's same income tax, same 24% bracket, but now you're right. We're just going to bifurcate the income into a salary piece and then just kind of profits that we're going to draw on. So now 25K is subject to payroll tax, and then 125K is just subject to income tax.
So that's a big savings.
Huge savings. Yeah. So that's where we think the savings comes in, about 75K. And so that's where it's a really big deadline to meet to make sure you're electing S Corp.
The only thing you have to be careful of is this is the planner coming out of me, is if you're going to lower your W-2, you're lowering your Social Security.
Right.
So if you're going to pay, yourself $25,000 a year, but you're really making about $150,000, which is, you get the lower tax bill.
Right.
You're also paying less in Social Security. So your Social Security statement is going to say you made $18,000, not $150,000.
Right.
Now, if you have ability to make more money, then I would say your baseline should be like the $160,000. So you get max Social Security. You can make your paycheck almost all tax and 401k contributions, right? And then you live off your draw.
Exactly.
That's fine. But for the lower income earners below the 150 mark, I would just be cautious that you maybe don't want to pay 100% of what you make into payroll, but you have to look at your plan and go, are you saving enough elsewhere? Because if you're, and I say this with love and respect for all my business owners, but a lot of people create jobs for themselves. They're not really creating businesses that can be sold in the future, right? So if you created a job for yourself, you got to make sure that you're saving enough that when you get to retirement, you actually have enough money to live off of.
Right.
Because if it's kind of hand to mouth,
right, then
you're going to end up in a situation where all you have is Social Security, and it's going to be a very small amount.
Right.
So just be careful of that.
Yeah.
Jordan, thank you. Anything else?
I don't think so.
Well, congratulations on getting past the October deadline. Now you're doing the planning.
Yep.
When do you rest?
Technically now, but
but you're ramping back up for 2024.
Between 8 and 5 only.
That's
Between
true.
8 and 5.
Between 8 and 5. Yeah. Well, thanks for coming back on the podcast.
Yeah,
and we look forward to having you again soon.
Yeah. Likewise.
All right.
Thank you.
Couple things. We have other podcasts you might be interested in. Episode 174, 2023 tax credits you should know about. We did that earlier in the year. Episode 150, can tax loss harvesting improve your investing returns? Spoiler alert, yes, they can. Listen to the episode if you want to learn more about that. We also have a YouTube channel. A Wiser Retirement is the title, just like the podcast. We have a video with linked 2023 Tax Smart Philanthropy. And then we have a link to Sute CPA's website on our show notes as well. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management, I want to schedule a consultation to meet with one of our fiduciary financial advisors. You can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. See you next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and/or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.